Hello, my name is Eric Merritt with HomeSmart of Northeast Mesa, and Eric Merritt sells easy real estate. So we are here today. Steve Kopus and I are my preferred lender. I have two other lenders as well, but Steve is my main lender. And we're going to talk about two programs that can talk about how people can get a conventional loan and do 3% down and have a much stronger probability of getting under contract. So I'm going to let Steve talk about these two programs.
Well, great. Well, what the programs we're talking about here, Fannie Mae has one and Freddie Mac has one. Fannie Mae program is called Home Ready. Freddie Mac program is called Home Possible. Okay, very similar. They both allow for somebody who's making less than $62,500 per year here in Maricopa County to qualify for a conventional loan without putting 5% down. They can actually put 3% down, which is a little cheaper than even an FHA down payment. And it'll also, as long as they're at least at a 680 credit score, it'll allow them to get the going rates out there that people with the top-notch credit get. And so that's a real advantage for some lower income people to be able to qualify for a home.
And closing costs?
Closing costs in general, if you were to look right now on one of these programs, if you had a 680 credit score and you were putting 3% down, let's say on a $300,000 purchase, you would get a rate of about 2.875 on a 30-year fixed. That would be a rate that had no points. You would pay no points for that rate. You would just have your standard closing costs. On a $300,000 purchase, that's probably $5,000. Maybe $5,500, depending on the HOA and the taxes and insurance, how much those are. But the total out-of-pocket and closing costs would be $5,000 to $5,500. As you know, right now, you either have to pay that yourself, or you have to find another means to have it paid because the sellers aren't willing to give you concessions. In a normal market, you can ask for the seller to pay your closing costs for you. You can't in this market.
2, 3, 4 years ago, no problem, but now.
Right. So since we can't, get concessions from the seller in order to cover our closing costs, another option is to actually just take a higher interest rate, and then we can pay your closing costs. So instead of taking that 2.875 interest rate, you can take a 0.5% higher, 3.375, and pretty much eliminate your closing costs. Okay, so now you don't need concessions. Now all you need is again, on the $300,000 scenario, all you need is your 3% down payment. That's $9,000, and you can walk into the property. Okay, yeah. And to give you an idea, by raising that interest rate 0.5% from 2.875 to 3.375, you're only adding about $80 to your payment on that $300,000 house. So for $80 a month more on your payment, you're eliminating $5,000 to $5,500 out of pocket that you have to pay.
Yep.
Yeah. So that's an option for you.
Yep. Yeah. And what about debt to income ratios?
The max debt to income ratio generally on these programs is 45%. So again, but debt to income ratio is the total amount of your monthly payments. So that's your car payments, your credit card payments, your student loans, if you own another house, it's your mortgage payment, just any monthly debt payments you have, not your utilities and things like that, but debt payments where you owe money. Those payments plus the proposed new house payment that you're trying to qualify for. If you add all those together, they can't exceed 45% of your gross monthly income. When I say gross monthly income, that's before they take any taxes or anything from it. So your gross monthly income compared to your gross monthly debt payments, 45%. In some cases, it can go to 50%. Generally, in these lower down, 3% down mortgages, 45% is where you're going to be capped.
Yeah. No, as far as calculating the debt payments, like on the revolving, it's not how much you decide to pay, it's what the minimum amount is that these credit cards want you to pay. That's how loan officers judge that's how they calculate what your monthly debt installations are. It's based on the minimum payment of all of these revolving credit card debts. Then you add your car payment, add your possible mortgage payment, and if you have a student loan, then that gets added too. That's usually 1% of the balance, right?
Yeah, Fannie Mae requires, if your student loan is deferred and you're not making payments, then it requires that we count 1% of the balance as a payment into your debt ratio. Freddie Mac only requires 0.5%. But that's only if they're deferred. If you're on an income-based repayment, we can count whatever that payment is, even if it's zero. We can use that to calculate your debt ratio. If you're actually on a repayment, but it's income-based. But if it's deferred or in forbearance or anything like that, we gotta put those fictitious payments in there. Yeah.
All right. So that pretty much explains the Home Ready and Home Possible programs. So if you like this information and you find it very useful and informative, please go ahead and like and subscribe and share our videos, and you'll be notified of future ones as well. And I thank you very much, Steve, for coming.
Thank you, Eric.
You're welcome.
All right.